Okay, so good morning, everyone, and welcome to today's macro snapshot. We are Friday, November the 17th, 2023. Okay, so yesterday was a relatively quiet session, but what I want to draw your attention to, guys, and what I want to focus on just for a little bit here at least is just the pretty significant price action in oil. So if we look at the CL1 contract, so this is the generic contract, we see we had a very big dump, and that's basically. I mean, the price action was fairly bearish because essentially we've been in a downtrend for since the high, when it's this late September or so, and this is the gap here. You see this gap here, which was on essentially the weekend of the 7th, 8th of October with the the situation with Gaza and Israel. But what's interesting is that there was a bit of a so-called war premium, which was priced in for 4 or 5 or 6 days. But that was about it, and it couldn't really muster up much. And ever since then, that's just started to fall back. And it's pretty simple that there are conflicting sort of forces at work in the oil market. On the bullish side, you do have potentially the possibility of an escalation with this geopolitical situation in the Middle East. But the reality is that at this point, the Iranians seem to have made it clear that they don't want to get particularly more dragged into this. The Americans have tried relatively hard, it seems, from this conflagration from spreading. And the most important thing, of course, is that neither anywhere on the Gaza Strip or the West Bank or in Israel itself are they sort of heavy about their oil producers. So the market just took a few days to sort of discount that, basically. And then also on the bullish side, you could say that we have the Russians and especially the Saudis with a 1 million barrel per day sort of unilateral cut, but that's fully priced in at this point. And what we have to understand, and this is in the context of the Saudis maybe prolonging that, is that it's one thing to cut a supply in a strong market, but if you continue to cut supply in a weakening market, or a market which may be perceived to be weakening, that is a signal of weakness, not of strength. And the market, will be like a shark scenting blood in water, and will home in for the kill and try and sort of probe for more downside weakness. On the other hand, of course, you've got sort of various conflicting signals about the global economy. It seems that China is still in the doldrums a little bit. Europe is maybe stabilizing. The US seems to be, relatively robust. But, for example, yesterday we had initial jobless claims and continuing claims at 8:30 yesterday morning, which were a little bit higher than expected. And so there is a little bit of a narrative building that the US, although it's still relatively robust, has seen the peak and is perhaps now sort of stabilizing, or maybe slowly deflating. We also had some news out of China. Chinese refinery runs were a little less. And of course, on Wednesday morning, we had the 2-week data dump from the EIA, essentially with their very large builds. So I would say that the market is relatively balanced, although at the moment the sentiment and some little indicators maybe a little bit more to the downside. And so I think just technically here, what the market wanted to do, we had that first initial sort of Fibonacci measured move down to here, but basically it couldn't support that. And then for me, the real tell was this rejection here. This is the moment where the bulls on Tuesday, on the 14th of November, on Tuesday, a couple of days ago, they could have pushed it higher, but that was substantially, rigorously kind of rejected and pushed down. So that's it. So if we just now go to the most liquid contract, which is now January 2024, we can see here that the market, very clean, elegant, technical move down to this level here, which we had on the charts of 72.88. Push through about 20 or 30 ticks below, just breaking stops. So where are we at now? What's the future path? I think, to be honest, really it's going to be revealed over the next couple of days. It's pretty simple here that the bulls are not in control in any shape or form. All they've done is to offer a first defense here. And so the first thing to do is that let's just break it down maybe sometimes to a 4-hour chart. It's a little cleaner sometimes to see. So there's the 4-hour chart of the January contract. So let's just look at, it's very simple. There's a few little tasks which the bulls have to do. So if we just throw it on a quick little fib here, we see that at this point, this is nothing. This is pathetic. This cannot even be considered really a recovery or a retracement. At the minimum, at the bare minimum, the bulls would need to start to push up to, let's say, 75.17 mark on the January contract here. And ideally, of course, which corresponds to this sort of little low here, then they need to push up through the 50% retracement. And I think the only first signs of sort of some kind of recovery or defense would legitimately just be over this sort of mark here, the 61%. So I'm going to call that anything over 76.92. Let's call it 77, keep our life simple. So I think really we have to get up to 77 for any kind of recovery. And then at that point, of course, you have to say, even on this sort of little impulse here, you've got this fib, or maybe even, probably better, this one here. So realistically, the first target is probably up here somewhere, really. I mean, we said about 77, but the reality is, even maybe up to 79.5 or 80, something like that. That's the work the bulls has to do. Now, as you guys can see, that's still, I mean, that's still 3, 4, 500 ticks away, $3, $4, $5. So significant work still needs to be done by the bulls. On the other hand, the bears at this point is very simple. And as I say, we just throw this fib back on even on the shortest dated fib. The bears at this point, it's still a downtrend. And if we go to, let's just go back onto the daily. We put it back onto the daily. This is still in a downtrend. I mean, there's nothing. This is a downtrend which has had, a $1, bounce. So at this point, the bears are still firmly in control. And any sort of weakness in today's trading, or over the weekend or anything like that, or any sort of weak economic sentiment, any weak economic data, lack of positive data, I think it's pretty simple. It's going to push down through this level, and then we have a problem, because at that point the market will definitely, I would say, probe down to these lows. So you're talking at this point mid-60s, depending where you want to sort of draw your lines. I mean, it could just be somewhere down here, or could even maybe try, in a more dramatic scenario, to flush out all of these lows along the $64 kind of mark. But that's quite a long way away. But to be honest, we have seen that. And just I will recall to everyone that last around about Thanksgiving last year, so about 1 year ago, when there was low liquidity in the market, we had a huge downdraft. We had the liquidity event. There was all kinds of sort of market makers selling into weakness. And now I'm not saying we're there, but we do have Thanksgiving coming up in the US next week, in a few days, and that will be a low liquidity kind of situation for 24, 48 hours. So just going to be kind of interesting. I'm definitely going to be looking at the market. Well, I look at the market all day, every day, but I'm saying definitely be looking at it with quite a lot of attention in that low liquidity. So just a couple of other things on oil here. I mean, some people are saying that there was rumors that the Saudis will voluntarily extend their production cuts maybe into the first quarter of 2024. Now, okay, could that put a little bit of a sort of a floor under the market? Quite possibly. There could also be a floor put under the market by, let's say, announcement from the White House of strategic petrol reserves being topped up. But the reality, as I say, the market is not stupid and understands that if the Saudis need to continuously cut production, ultimately that is coming from a sign of weakness. And secondly, it's also giving a bit of a lifeline, throwing a lifeline to the shale producers in the Permian over in West Texas, and who, as we've been seeing over the last few months, have been ramping up their own production. So it's kind of counterbalancing in some shape or form the Saudi cuts. So the more the Saudis cuts, it just means that other producers who maybe have a little bit of spare capacity, there's not a huge amount of spare capacity, but a little bit of spare capacity, mainly in the Permian Basin, are ramping up. Okay, just a couple of other things here, guys. Let's just look at just a couple of little charts here to put this into context. So we've got here, just look at the shape of the curve. So this is from 1 week ago. This is WTI. So you can see 1 week ago, obviously the outright prices were much higher and the curve was at least flat. But what we've seen in the last week, we've seen that the front prices not only have dropped significantly, but of course, as you can see, the shape of the curve, we're now in a shallow contango, which of course is not a great signal. It's a bearish signal. And if we just look at a couple of the spreads here, let's look at CL1 minus CL2. So that's just the two front contracts. And you can see that as recently as, basically early October, we had a backwardation of $2.38. That was a bit extreme because of the what was happening at Cushing. But subsequent to that, we've seen that the inventories have been building at Cushing. We saw that in the Wednesday data that I think it was up another 1.5 million barrels or so. So we're kind of off the low danger levels at Cushing, and basically that's brought down the prompt spread here quite a lot, until the fact that we're now in contango of 19 cents. And if we actually push that out a little bit, maybe put that on onto the CL3, we can have a look here. We can see Yeah, so that's a similar kind of situation. We had a backwardation of $4.38 between CL1 and CL3. We're now in again into contango a little bit deeper of 26 cents. So the point is that all of the time spreads, the calendar spreads, the inventory are getting lower going into contango. The inventory levels are building up. Global demand metrics are, let's call it neutral at best. They're certainly not particularly bullish. And that's just been a perfect excuse for people to keep pushing the market lower. And remember, we know that the oil market is not as liquid as it was maybe a few years ago. And we also know that, once those stops start getting triggered, we start getting sort of gamma flips and everything, and the dealers start sort of selling into weakness. But for today, for the last few hours, overnight session, it's stabilized a little bit. But I think we are definitely neutral at this point. And we'll just have to see how the price action plays out. Okay, so on to other things, guys. Just while we've got the chart up here, not a lot of data today. In fact, not much at all. I think we have housing starts, building permits. I mean, it's always interesting to see how that's going. We have a few Fed speakers, but really we don't have anything significant until next week. We get the FOMC minutes on Wednesday, which may give us a bit more color about what the Fed's speaking. But I think the other thing, which is for me is going to be pretty interesting, is that on Monday at 1 p.m. we get the 20-year auction. So not 30, the 20-year auction. And you'll remember that about a week ago, like last Thursday, we had a very, 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 very poorly received 30-year auction, which caused yields to spike, and the equity sold off in a pretty dramatic reaction. So what's going to be quite interesting is just to see. Now, the 20-year is a bit of a particular beast, but let's just see where we're at. And what we have been seeing, if we just look at the yields at the moment, let's just go and look at some of those yields. So if we look at the 2-year here, we see that in general in the US space, but also over in Europe in the German Bunds, we've seen that the yields have just been coming off, and that's just on this sort of narrative that the Fed is done, and that the real economy data is kind of weakening. And again, yesterday we saw initial jobless claims that ticked up, I think, by about 5 or 10,000, continuing claims pushing up a little bit. Now, those numbers in themselves are still, from a historical perspective, very, very, very solid. But the reality is that the trend, the direction of travel, does seem to be weakening for the labor market, to be ever so slightly weakening. Not enough in any shape or form to call it a recession, but enough to say that, perhaps there is something sort of gurgling away, bubbling away there. And that's enough just for the market has fully priced out. If we just look at what the market's pricing for the Fed, we can see that it's basically at zero at this point. So if we just go to the implied, let me just find it here, the implied yields. You guys can see that for the upcoming December meeting, absolutely zero, flat, zero, no chance of a hike. And then we start seeing negative signs, minus signs here. So at that point, you see here on the visual graphic, it's flatlined. The market essentially thinks that the Fed will be sitting on its hands for another few meetings. And then, in fact, it's been brought forward to the 1st of May. You see here the 1st of May, 2024. We've got 21 basis points out of a 25 basis point cut. So we could call that almost the first cut, 85% here priced in for the 1st of May. So essentially, the narrative at the moment is for the Fed to do nothing for, about 5 or 6 months, and then to start cutting. Now, by the end of the year, the market has basically said that, between the terminal rate, 5.33, and by the end of the year, let's call it here, we're talking about, it's about 100 basis points. So you see from 5.33 down to 4.33. So the market is basically saying here it is here, 3.9 cuts. So there's four cuts, 100 basis points is priced in. Now, at the moment, a lot of the big institutions are having different means. Some people saying, no, that's too dovish. The economy is going to be relatively robust. Jerome Powell wants to protect his legacy. He doesn't want to be known as Arthur Burns, who let inflation run. And so Powell, may not cut until September, October, November, and they may only end up cutting 25 or 50 basis points. On the other hand, you have doves. Some of the banks, I think UBS, I think I spoke about it yesterday, they're calling for, I think, 250 or maybe even 275 basis points of cuts. So there's a lot of how can I say, just divergence of opinion amongst traders and amongst institutions about what the path is next year. And that's why it's a bit tricky at the moment, because everything is just being shaken up by the data, and we had slightly so-called, sort of dovish data yesterday. And that's what we're seeing, is that we're seeing the yields You see here the 2-year yield on the 1-year on the daily chart. You see the 2-year yield just coming down. We also see the 5-year coming down. Kind of interesting levels there. I've got a potential alert there to start shorting the 5 at this point. We've got the 10 here coming down quite a lot. And it's just interesting to me that you see the 10, it's come off its highs of about 5%. We're now trading at about 60 basis points below that, 0.6% below that. So you've got to say, I'm looking at this level here of maybe 4.31, which is a bit of a significant level, as you guys can see here. I just wonder if we get into something like this zone, there might be a few market participants thinking about shorting the 10-year at that point. Because you've got to say that with, we still have a huge amount of supply coming into the market over the next couple of quarters, probably 2 or 3 or 4 quarters, all of next year probably. And that's why that next year on the 20-year auction, if that's poorly received, that could be the catalyst for a further a renewed sell-off, and maybe these sort of interest rates going up a little bit here, or yields going up rather, I should say. So that's that. Let's just keep an eye on all of that kind of stuff. Just in terms of gold, gold, it came back down from its highs, did a 38% retrace here. To be honest, as long as we continue to see real yields going down, US dollar, not particularly collapsing, but the US dollar sort of trading a little on the heavy side, why not gold to go and retest, let's say the 2000 level for a start, and then maybe up to 2008, this kind of level up here. Just in terms of the equities, guys, we see the VIX. What's actually interesting is that the VIX is down at lows. VXX, you see, is actually losing value here. It does like a VIX futures curve, which is more in backwardation rather than contango, which is the case at the moment. But anyway, getting back to the VIX, that's down at pretty low levels here. So what's interesting is that anyone who wants to hedge a portfolio, or if you just want to do sort of a directional sort of gamma, a long gamma kind of play, so any kind of directional play, a long put, a long call, maybe some kind of straddle kind of situation. This is a pretty good moment for any sort of just sort of long volatility call, because volatility is low, it's attractively priced, and so that's something to really sort of think about. And we're actually thinking today maybe putting on some kind of long volatility sort of play. So that's just something definitely to be interesting in at these low levels. This is a great time to just be thinking about that. Just in terms of, just quickly have a look at the ES. We had a little bit of a pause, but the reality is this chart at this point is bullish. I mean, there's nothing more to say about this. We had, we've had the huge uptrend essentially since the QRA was less than expected back on the Monday, or the 30th of October. It's been up ever since. We haven't really had any pauses. There's been no significant pullback. At this point, you have to simply say that the chart is bullish. And that I guess the next target is probably something on the ES1 here, 45.62. I mean, that seems pretty clear, and maybe even up to here, up to the top. We shall see. Similar kind of situation with the NASDAQ. NASDAQ is a bit, it's kind of interesting because we did get to that very important 16,000 level, which was rejected, as you guys can see here. So NASDAQ sort of in a slightly different technical picture. But the reality is that chart also, except for this rejection spike, is pretty bullish. So if the bulls can keep it rolling today, you've got to say that, a retest of that 16,000 high is completely on the cards. Now, that will be significant resistance. I guess we'll see maybe going into next week what happens there. But for sure today, I don't see any reason why that can't, grind up towards there. What is interesting, always just keeping eyes on the small caps, the Russell. Again, that was rejected at this key level the other day, along with the NASDAQ. Yesterday, a bit of a down day, but sort of hanging in there. But the overall trend is for the small caps to be underperforming the mega caps. We all know, about the Mag 7, et cetera, et cetera. So that's definitely something there. Finally, guys, what I just want to talk about is the Italian situation. This is the BTP, so the 10-year bond over in Italy, which, as you guys can see, had a retest of the bottom, and which promptly went up into a pretty aggressive kind of recovery here. Now just sort of pausing. This is very interesting just because the Moody's agency, they are due in theory after the market closes today or Friday to perhaps issue a ratings warning on the Italian debt situation. They might downgrade it. Now, if they were, it's just one notch Moody's above junk. So just one level above junk, which is different to Fitch and S&P, which is Standard & Poor's, which is a little bit higher. No one it would be a pretty major shock to the market if Moody's were to downgrade Italian sovereign debt today after market close, because at that point they would be putting it into the junk category. Now, this is the third largest economy, I believe, in Europe after Germany and France. And so to put the Italian sovereign debt into the junk category would have pretty serious implications. Firstly, that would be obviously horrible for the BTPs. The spread between the Italian bonds here and the German bonds, which, as you guys can see, has been coming in. So it had reached a high of about 215 basis points, but it's come into about 175. That would obviously sort of go up. The Italian bonds themselves would sell off, and also the euro would probably be under a lot of pressure, especially against something like the Swiss franc. But that's the story for probably sort of for the Sunday night open. So anyway, it's just something to be looking out for. On the other hand, most market commentators don't think Moody's will do that, because essentially that will put Moody's too much in the spotlight as potentially provoking I don't want to say a crisis, but maybe a mini crisis in the European debt situation. So that's definitely something to be looking at after the market closed today and over the weekend. Potentially those of you who want to do it, sort of to trade it at the open on, actually it's Monday morning about 2 a.m. So that's definitely something to be something which is going to be on my radar. Okay, guys, so that's about it for today. Let's just see how the equities, if they grind up. Personally, I'll be looking a lot at the oil market, and as I say, it's quite an interesting moment to be considering sort of long volatility. Any kind of sort of long volatility trade or structure is attractively priced at the moment. We'll leave it there. Have a great weekend. We'll be talking next week. Thank you.